I'm Audie. Welcome to the channel. Today we are discussing how the game just changed for investors. On May 1st, index providers quietly rewrote the rulebook for the NASDAQ 100. Because of this massive shift, the era of the safe, passive tech ETF is officially over. For decades, students and retail investors were taught the old promise of a simple rule. This was blind dollar cost averaging, which meant automatically buying the index every month. It acted as a reliable safety net because the basket only contained 100 proven, stable mega corporations that had survived rigorous vetting. However, we are now seeing a quiet revolution in the passive market. Index providers are changing the rules to attract massive, unproven tech IPOs. To get these giants into the index quickly, the traditional safety barriers have been completely removed. The result is that extreme IPO volatility is being injected directly into your passive retirement and savings accounts. Deconstructing the new rulebook reveals some shocking changes. Under the old rules, IPOs had a 3 to 12-month price discovery period before entry. A minimum 10% of shares had to be tradable, and rebalancing happened annually. The new rules feature fast entry in just 15 days, only a 5% float requirement paired with a phantom 3x multiplier and quarterly rebalancing that increases ETF trading costs. Ultimately, this shifts the core nature of the index from stable, verified megacaps to instant IPO volatility. Let's look closer at the concept of bypassing the line with fast entry. The old way required IPOs to wait 3 to 12 months for the market to agree on their true price, which successfully protected passive investors from buying at the top. Now, with the 15-day flash, a mega IPO is evaluated at day 7 and forced into the index by day 15. The massive risk here is that ETFs must buy the stock before its true market value is ever discovered. Next is the illusion of the phantom float. Traditionally, the float rule meant ETFs could only buy shares that actually exist in the public market. Now, the new multiplier dictates that if a company only lists 5% of its shares, the index mathematically pretends it listed 15%, applying a 3x multiplier. Mathematically, if a stock has a 10% float, the ETF is forced to allocate weight as if it had 30%. This artificial multiplier creates a dangerous forced buying squeeze. Think about what happens when a $260 billion ETF is forced to buy massive allocations of a new stock within just 15 days. If only 5% of the shares are publicly available, the ETF must fight to buy a tiny pool of stock. The outcome is that the ETF drastically overpays, artificially pumping the stock price up with everyday investors' money. This setup perfectly illustrates how passive investors become exit liquidity. The new rules mechanically force your passive ETF to buy at inflated prices exactly when early insiders are looking to cash out. In summary, the passive ETF's forced buying at peak prices acts as the perfect safety net for insiders to cash out their stakes at maximum value, leaving everyday investors holding the bag. The historical reality is that mega IPOs swing wildly in their first 6 months of volatility. Under the old rules, the index safely waited out this turbulence. But under the new rules, your passive portfolio is riding the roller coaster right alongside them. For example, Alibaba saw a 38% day one jump, followed by a 39% plunge, while Uber saw a 50% plunge around its initial lockup and a 33% drop at its 6-month lockup expiry. This isn't just contained to one index. There's a contagion effect across all indexes. You cannot just hide in another ETF. To attract the $4 trillion pipeline of upcoming IPOs, nearly every major index provider is adopting these aggressive rules, with the S&P 500 already testing float rules and reviewing fast entry protocols. It is time for waking up from blind investing because the free ride is definitively over. Dollar cost averaging is still a proven strategy, but blind, unthinking DCA is now highly dangerous. In the new market, the index itself has become an active battleground. The requirement going forward is that passive investors must now actively monitor the rules of the game to avoid being preyed upon. To protect yourself, you need to use the new Investor's Tactical Calendar. Understanding 3 key events allows you to predict massive artificial price swings in your ETFs before they happen. First, track the float percentage of tradable shares at IPO to determine how hard the ETF squeeze will be. Second, watch the lockup periods at 90, 180, and 365 days post-IPO, which is when insiders dump their shares. Third, monitor the S1 filing on the SEC IPO calendar to know exactly when the giant is coming to the market. If you want to opt out of this game, focus on finding alternative paths. If you reject the new volatility rules, you can bypass the main index entirely. Look for targeted baskets like sector-specific ETFs, such as the Mag 7, semiconductors, or cybersecurity, which allow you to hold proven, cash-generating tech giants while specifically excluding unproven, cash-burning IPOs. Ultimately, you must learn the rules to master the game. The system has been redesigned to use passive capital as liquidity for insiders, but visibility is your greatest defense. By thoroughly understanding fast entry, phantom floats, and lockup expiries, you transform from being exit liquidity into an informed, empowered investor. Just remember, investing in options involve risk and aren't for everyone, so treat this as an educational guide for your financial journey. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.